Hi, everyone. I'm Sarah Laura from the Lewis and Clark Low Income Taxpayer Clinic. If you were just trying to join us on our Facebook Live event, I'm terribly sorry we had some technical difficulties, but we are here to bring you the presentation of our students, Peter Broberg, Jordan Boboa, Peter Esho, Kate Shepard, and who am I missing? Ian Pake. Sorry. Okay, so let's get started. Jordan.
Hi, everyone. My name's Jordan.
And I'm Peter Broberg.
And today we're just going to do a dive into everything that will help you make your tax season a little bit easier. Before I get started, I just want to make sure everyone's on the same page and we all know what a legal clinic is, and then I'll talk about what the Lewis and Clark Low Income Taxpayer Clinic focuses on. So a legal clinic is either a legal aid or law school program that provides services to clients and gives hands-on experience to students. They're typically run by a clinic director. In our case, it's Professor Sarah Laura. And legal clinics typically do pro bono work for low-income community members, and services are typically free. The Lewis and Clark Low-Income Taxpayer Clinic represents low-income taxpayers in controversies with the IRS, the Oregon Department of Revenue, and that includes audits and appeals, trials, hearings before the U.S. Tax Court, and appeals to the U.S. Court of Appeals in the Ninth Circuit. And just so everyone knows, if you're watching this, then you found it somehow, but it will be posted on the website and on the Facebook page. So spread the word. Today, Peter and I are going to start with how to file taxes, what you need, where to file them, and when you have to do it by. And then tax benefits for college students who can qualify and how they can help you, what you need to do in order to get those benefits.
All right, great. Thanks, Jordan, for the intro. Again, I'm Peter, and I'm going to be just walking through how to file your taxes. This is kind of aimed at maybe a young adult who, maybe this is your first year with a job or your first year not living at home, you're off at college and aren't sure how things are different than when you might have done this before. Great, so first, what you need to file your taxes. The first things that you need are all the forms that get sent to you, your W-2 forms, which would be forms from your employers to report how much you earned and how much tax is already being withheld. This is all based on that paperwork you filled out on your first or second day on the job. And yeah, it's pretty standard. They are either electronic or mailed to you, kind of depending on how big and modern the company is. You need any 1099s that you have, which are forms that report money that you earned outside of what employers report on a W-2. So probably taxes, or I'm sorry, we're talking about taxes. Tips is what I meant to say. 1098 forms are interest payments and expenses you can deduct, like mortgage interest or tuition expenses, which is probably relevant to you if you found this here. You will also need any documents, forms, or receipts with other income you made during the year, documents for any taxes you have already paid. If you are, your first year out of the house and previously you might have done your taxes with the help of your folks or something like that, it can help to use whatever software they used. Like if you use TurboTax, then your information is probably saved. But you do need to keep your information from year to year. It's just a little easier if it auto-populates. But if you don't have it already filled in, you need to have your information from last year. You need last year's tax return, more specifically your adjusted gross income, your bank account number, and your routing number to get a direct deposit for any refund you might receive at the end. Otherwise, they will mail you a check and it takes several weeks to get it. You need your social security number or individual taxpayer identification number, or ITIN, You get that if you don't have a social security number, because you still need to file taxes even if you don't have a social security number. And finally, you need to determine if you can be and are being claimed as a dependent. All right. And then just as a pro tip from me to you, you want to keep any mail that comes that says tax information enclosed. I'm a little bit old fashioned, and just having the pile of papers that all say tax information, it says what kind of form it is, and it makes it all really easy just having it all sitting in front of you. And if you just keep it in a stack, when you set aside the time to do it, you can just get the stack and have everything you need. It's pretty easy to do. All right. So one thing that is a little bit tricky can be determining if you are a dependent. Ideally, you are going through this with the person that might be claiming you as a dependent. Together, you want to avoid a situation where one of you is where you're claiming that you're independent and they're getting some tax breaks, and they're claiming you as a dependent and they're getting tax breaks. So you'd be kind of double dipping in your potential tax refunds. So one way you can be a dependent is if you're claimed as a child. Pardon me, I'm on the wrong page. Here we go. So the summary of the definition is kind of broad, but it's also specific. So I'm going to walk through it right now real quick. You can be a son, daughter, stepchild, foster child, or a descendant like a grandchild. Or you can be a half brother, half sister, stepbrother, stepsister, or a descendant like a niece or a nephew. So a lot of categories. There are 4 tests to determine if you count as a child that can be claimed. If you are 19 or under, or if you're a full-time student, that age is bumped up to 24. So if you're off away at school and 23, you could still be potentially claimed as a dependent. Or any age if you're disabled and dependent upon whoever would be claiming you, so the parent type figure. You normally have to live with the person for at least half the year. If you're a full-time student in a way, that changes that category. The child can't provide more than half of their own support. And this doesn't include scholarships and student loans. So if this is another time you might need to talk to your dependent. Maybe someone thinks they're supporting more than half of your income, but they're really not. They don't realize how much money you're making or how expensive your life is. You need to talk to them about that. And you can't file a joint tax return except to get back taxes withheld from your pay. The other category that you can be a dependent in is as a relative, which is the next slide. Relative also is defined broadly, but it's specific. And the full definition can be found at that link, which just takes you to kind of a big PDF. You'd want page 35 of the PDF if you click on it and it doesn't look like what you're actually looking for. This also has 4 tests. So you, the person who you're trying to figure out, you can't be claimed as anyone's child. So that's just moving you into the second category. You have to either live with the taxpayer or be on this list for relatives, which I'm going to run through, but it's long. It wouldn't fit on the slide. So it is a stepchild, foster child, descendant, for example, a grandchild, brother, sister, half-brother, half-sister, stepbrother, stepsister, father, mother, grandparent, or other direct ancestor, but not a foster parent. Stepfather, stepmother, son, daughter, half brother, half sister. There's a lot. That is Oh, I missed one. Your son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, or sister-in-law. So pretty much anyone who fits on the family tree reasonably can claim you as a relative if these other parts of the test check out. There we go. So how to file. E-filing is the preferred way to do it. It's faster and works better. There are many online services that will easily cover all of your standard tax situations. The IRS website lists options so you can pick which service best fits your needs. This is because they try to make it easy. So if you are, like, say, a veteran, there's a special veteran filing service that has more tailored questions for you to make it more straightforward. If you made less than $72,000 last year, several of the options are free. Here's a link to the IRS free site for the different options. And like Jordan mentioned, we're going to post this up so you can click on all these links. Wherever you found this, you can also find this presentation. Alternatively, if you don't want or can't do it online, you can mail in your taxes. The IRS estimates a 6 to 8 week delay on processing your refund by mail. So just a heads up, if you have to mail it in, it does take longer. And just so you know, cashoregon.org is a great resource, a great organization. If you need help, you can reach out to them. There's a link to their website. They do say that because this is prime time for taxes, there are long wait times. So if possible, they recommend trying to do it yourself. If you run into a problem, then you can reach out to them. All right, and when are they due? So May 17th, a little over a month from recording. So hopefully before you watch this, if you need it, but taxes are due on May 17th. Taxes are always due on tax day. Makes it sound like a holiday. Normally tax day is April 15th, which is today as we record this. Unless April 15th falls on a Saturday, Sunday, or holiday, you probably don't need to know that. You can just Google when is tax day. But for you to know for this year, May 17th. It's different because of the stimulus payments. So the IRS decided to give a little extra time. All right, and as a recap, first, compile all your documents. It's so much easier when everything is just in front of you and you're not scrambling trying to find information. Then you e-file or file by mail, by mail, and then you will either receive a refund or make a payment if you owe. And if you are expecting a refund and you either don't get the money or the IRS contacts you for some reason, talk to a nonprofit organization such as a clinic for assistance with sorting through it, making sure that you get what you're due, or just knowing how to respond to whatever correspondence you get from them.
All right, and now I'm going to talk about tax benefits for college students. So I want to focus on two tax credits, specifically the American Opportunity Tax Credit and the Lifetime Learning Tax Credit. But before I dive into both of those, I just want to make sure everyone's on the same page as to what a credit actually is. A tax credit is an amount of money that we as taxpayers can subtract directly from our taxes that we owe to the government. So tax credits reduce the actual amount of taxes we owe, and that's different from deductions, which I'll talk about in a little bit. And deductions, rather than reducing the amount of taxes you owe, they reduce the amount of taxable income you have. So the American Opportunity Tax Credit is a credit for the first $2,000 that you spend towards educational expenses, plus 25% of the next $2,000. So that makes a max of $2,500 for each of the 4 years you attend college. If your eligible amount for this credit exceeds the amount that you owe, then you can get a refund for up to either 40% or $1,000, whichever one is less. The lifetime learning tax credit is a credit for the first 20% of the first 10,000 in tuition. So that equals about $2,000 a year. Unlike the American Opportunity Tax Credit, though, the lifetime learning tax credit doesn't allow any refunds. So if you don't owe anything to the IRS and you still have a credit, you can't get a refund for it. All right, you can qualify for the American Opportunity Tax Credit if you're a student who's enrolled at least half-time during the academic year, and if you make less than $80,000 if you're single or head of household, or you make less $160,000 or less if you're married filing jointly. This credit does phase out when you start making more and more money, and it'll completely disappear once you make over $90,000 if you're single or head of household, or $180,000 if you're married filing jointly. And this credit can't be applied towards room and board expenses. And to qualify for the lifetime learning credit, you have to make $57,000 or less if single or head of household, or you have to make less than $114,000 if married filing jointly. And this tax credit also phases out completely if you make $67,000 or more if single or head of household, and if you make $134,000 if married filing jointly. You have to be in some sort of college program or in a program designed to acquire and improve job skills, but the courses that you're enrolled in or had already taken have to be offered by an eligible educational institution. And the big difference between the lifetime learning credit and the American Opportunity Tax Credit is that the lifetime learning credit doesn't have a limit, where the American Opportunity Credit you can only use for 4 years. So realistically, if you stay under that threshold of $67,000 for a single person or $134,000 for a married couple filing jointly, if you stay beneath that threshold and you just get degree after degree after degree, then you can utilize this credit forever. Okay, how do you claim these credits? So in order to claim the American Opportunity Tax Credit and the Lifetime Learning Tax Credit, you use the same document and you fill out a form 8863 with your income tax return, which is Form 1040. And here's a little picture of what that form looks like once you find it. There are other ways that college students can save money, and I'm going to talk about 2 more. The first one is the student loan interest tax deduction, and the other one is scholarships and fellowships. So like I said before, there's a difference between credits and deductions, and where credits reduce the amount of taxes you owe, deductions reduce the amount of taxable income you have. So for the student loan interest tax deduction, if you've paid any interest towards a student loan, you can deduct a maximum of $2,500 of the interest you paid on your income tax return. And there's a link right there. There's links trickled throughout this whole thing that you guys can click on and have access to. And it just is more detail and it'll give you a step-by-step on what to do. For scholarships and fellowships, those are also great ways for students to save money. Scholarships and fellowship grants are different from loans because this money you don't have to pay back. And if you receive a scholarship or fellowship grant, all or at least some of the amounts you receive may be tax-free. So you can qualify for the student loan interest tax deduction if you have paid interest on a student loan during the year, if you filed single or married filing jointly, and if you make $80,000 or less if single or $160,000 or less if married. This deduction doesn't apply to loans that you've gotten from friends, families, or your employer, though. And scholarships and fellowships are tax-free only if you're a candidate for a degree at an eligible educational institution, and if you use the scholarship or fellowship to pay for qualified education expenses. And for each scholarship or fellowship grant that you apply for, there's just tons of different scholarships out there. I saw one today when I was looking for scholarships, and it had something to do with Halloween costumes. So you can really find a scholarship for anything. It's just about seeking them out and then, doing what you have to do to get it, writing that paper or just doing what has to be done. But there's 3 links right here to help you find scholarships or fellowship grants. And like I said, we have a bunch of links. Can't have too many links. So here's a ton more. There's examples of the forms we've talked to you about today. There's what some of the buzzwords we talked about today are. So what qualified expenses are, what eligible expenses are. There's links to all these right here. If you have any questions about any of the links we posted or any of the slides, please reach out and we'll be happy to answer them.
Thank you, Jordan. That was amazing information. We will hand it over to the second group of students who will talk about the child tax credit.
Thank you, Jordan and Peter. Before we start, we'd like to introduce ourselves. My name is Peter Isho.
And I'm Kate Shepard.
My name is Ian Pake.
And we're here to talk about the child tax credit, who qualifies, what the American Rescue Plan changes for tax year 2020. So just some background that I know Jordan and Peter touched on. We are the Lewis and Clark Low Income Taxpayer Clinic. We're a free need-based legal clinic representing clients in federal tax matters, and we specialize in client controversy with the IRS. The 3 of us are student interns. We represent low-income taxpayers in IRS and Oregon Department of Revenue controversies, ranging from audits, appeals, trials, and hearings in the U.S. tax court. Part of our mission also is to identify issues that low-income taxpayers face and educate them on these issues. That's sort of the basis for this presentation today. So the goal of our presentation today is to raise awareness to taxpayers with children that they may qualify for the child tax credit. To put it differently, our goal is to help you get money you're entitled to back from the government. So first off, what are tax credits? A tax credit is an amount subtracted from the amount of tax you owe. And there are 2 types. So first are non-refundable tax credits, which reduce the total amount of taxes you owe. But there are also refundable tax credits where you may be entitled to the full amount of the credit, even if it's more than the tax you owe. Now I'm going to pass it to Kate.
Okay, and I'm going to give us a little bit of background on the history of the child tax credit. The child tax credit is a fairly new program. It was created by the Taxpayer Relief Act of 1997. In its original form, it was a non-refundable $500 per child credit that provided tax relief mainly to middle and upper middle income families. And then continuing on through the modern day, Congress actually increased that non-refundable tax credit to $1,000 per child in 2001, and in 2003 and 2004 further accelerated those changes. In 2008 and 2009, part of the Emergency Economic Stabilization Act expanded availability and the amount of the credit to taxpayers whose incomes were previously too low to qualify for the credit, or they were ineligible for the full credit. And then since 1997, so in 2017, Congress actually doubled the maximum amount of the credit, but they also instituted a Social Security requirement. So all taxpayers needed to have that Social Security number for the child that they were going to claim. So that was new in 2017. This year, in 2021, Congress passed the American Rescue Plan, which expanded the child tax credit in some pretty significant ways that we'll touch on here. And all of the modifications that we are discussing today, they are currently set to expire at the end of 2025. So the information will be definitely useful for a couple more years. However, it will expire if Congress does not renew. And I'm going to pass it over to Ian to continue.
Thanks, Kate. So here we wanted to highlight that the child tax credit is different than the earned income tax credit. Importantly, these two tax credits differ in their purpose. The child tax credit is designed to help families offset the cost of raising children, while the earned income tax credit intends to boost work efforts and extend earnings into the next generation. Here on this table, you'll see that the maximum value of credits also differ, as do the credits' respective refundability. So as alluded to earlier, the child tax credit underwent some changes under the new American Rescue Plan enacted in 2021. First, the Rescue Plan set the child tax credit for 2020 returns to $2,000 per qualifying child claimed as a dependent with a qualified Social Security number. Second, and more interestingly, the Rescue Plan expanded the child tax credit for 2021. 17-year-olds now qualify for the child tax credit. The credit increases to $3,000 per child above 6 and $3,500 per child under 6 years old. The $2,500 earning floor requirement is removed to increase access to the child tax credit, and the credit is now fully refundable like the earned income tax credit. Lastly, half of the credit can be received in advance through periodic payments by the IRS from June through December of 2021. And then here's a table that just highlights these differences between the child tax credit before and after the American Rescue Plan. The changes to the child tax credit introduced by the American Rescue Plan help further the purpose of the tax credit by expanding access to the credit while concurrently increasing the help and value of the credit for each family. The increases to the credit also reflect an acknowledgement by the government for the difficulties and hardship COVID has caused Americans. And now I'll send it back to Peter.
Thanks, Ian. So there's a lot of research showing the long-term benefits of having a child tax credit. Namely, the Center on Budget and Policy Priorities indicates that children in families that receive tax credits do better in school, they're more likely to attend college, and they can be expected to earn more as adults. Specifically, for each $1,000 increase in annual income over a 2 to 5 year period, a children's school performance improves on a variety of measures, including testing scores. That means a credit worth about $3,000 during a child's early years could boost his or her achievement by the equivalent of about 2 extra months of schooling. And again, both the child tax credit and the earned income tax credit lifted 9.4 million people out of poverty in 2013. And that number includes 5 million children. And it also made 22 million other people less poor. So some of the projected benefits of the 2021 American Rescue Plan expansion of the child tax credit is a projected reduction in child poverty from 13.5% to 5.9%. Now that's a 56% reduction in child poverty, which is a pretty significant number. Even more significantly is that these reductions are expected to largely impact Black, Hispanic, and Native American children. So here's just one slide showing some of the Center on Budget and Policy Priorities findings about the tax credits anti-poverty impact. So as you can see here, 13.1 million children being lifted out of poverty and made less poor is definitely significant. And then when you account for all people, 31.7 million, that's a lot of Americans. That's a lot of money that is being put back into pockets of people like you and I that go towards a lot of positive benefits for children and just families in general. And I'm going to pass back to Kate.
Thanks, Peter. There are even more findings that show how beneficial these tax credits are in the lives of Americans. So the earned income tax credit and the child tax credit work together to improve infant and maternal health. As Peter touched on, children who receive these credits have better school performance. They've been able to show greater college enrollment stemming from these tax credits and the way that they impact children's lives. Um, these tax credits have also been shown to increase the work earnings that are passed along to the next generation. And finally, these tax credits also help to boost the Social Security retirement benefits for Americans by allowing them to keep more of their income that they've earned and use that towards their Social Security benefits. And so we'll walk through some of the tests that you'll need to meet in order to claim children for the child tax credits. So first, the child must be under the age of 17 at the end of the tax year for which you claim the credit. One of the major changes in 2021's expansion of the child tax credit was that children age 17 can now be claimed under the American Rescue Plan. Additionally, the child must be your own child. It must be a stepchild or foster child. Adopted children, of course, count. You can also claim your brother or sister, your stepbrother, your stepsister, and descendants of any of those people as well. And then also, the child cannot have provided more than half of their own financial support during the tax year. And they must be able to be claimed as a dependent. So Jordan and Peter walked through the dependent test earlier on in this presentation. And so ultimately, if you meet the dependent test, as they spoke about, you will also have met it here for this test. And I'm gonna pass it right back to Ian.
Thank you, Kate. So continuing on, we have a few more tests that round out the which children qualify criteria. We have the citizenship test, which requires that the claimed child be a U.S. citizen, national, or resident of the United States. Starting 2021, children must all have a valid Social Security number as well. The residency test outlines that a qualifying child must have lived with you, the claimant, for more than half the year. However, special circumstance exceptions exist for this test. And lastly, there's a family income test that determines if the child tax credit will be reduced, and that is dependent on whether your income exceeds certain amounts. So how do you claim the child tax credit? Well, first you have to file a tax return, which you can always reference Jordan and Peter's presentation on. And the child tax credit may eliminate any taxes that you owe when you claim it on your return. You are allowed to claim any remaining child tax credit money as a refund by submitting a Schedule 8812 additional child tax credit. So just to give a quick recap, the American Rescue Plan was a $1.9 trillion COVID relief package that included temporary increases to the child tax credit beginning in 2021. The plan increased the child tax credit amount and allowed 17-year-olds to qualify. In turn, it also phased out individuals that earn more than $75,000 a year if they file individually, or $150,000 if they file jointly. Even if families find themselves phased out or ineligible for the new $3,000 2021 child tax credit, they can still try and claim the $2,000 child tax credit. Lastly, the plan enables families to receive the 2021 child tax credit early in monthly installments from July through December of the 2021 year, sort of just as a reflection that the government realizes that COVID has had long-lasting impacts. Now, Peter will take us home with this presentation.
Thank you, Ian. So according to the Center for Law and Social Policy, the American Rescue Plan's changes will cut child poverty by roughly in half. Specifically, poverty levels among Black children is expected to fall by 52%, and for Hispanic children, 45%. Now, really, I mean, what we're talking about here is more money in the pockets of families who need it most. Even before the pandemic and everything that went on, this credit has, as shown by this presentation, had some pretty significant impact on families' abilities to, support their children, support their livelihood. So, these are numbers that should be taken pretty seriously and reflect like a pretty positive impact. So just to conclude, the child tax credit is a powerful anti-poverty tool proven to substantially benefit families and children. Again, as Ian mentioned, to claim the tax credit, a parent must file a tax return and the child must meet the defined requirements as established by the tests. And legislation to reform and update the child tax credit this year may mean that credit will become even more impactful and broad reaching in the lives of American families. And then finally, here's our the Low Income Taxpayer Clinic's contact information. If you have any questions or concerns, we can be reached here. We thank you all for attending our presentation. And yeah.
Very good. Thank you so much. A round of applause for our wonderful students. That was just fabulous. And I'm really proud of all of you. And we'll get this all posted both on our Facebook page and on our website.